Jerome Powell, the person in charge, has decided to halt interest rate increases, making this the first time in 15 months.
Leaving them unchanged after 10 straight increases.
Federal Reserve holding rates steady in the current range of 5 to 5.25%.
However, this move isn't happening amidst ongoing high inflation, creating a challenging situation that requires explanation. Although the rate hikes have been paused for now, Powell warns that more hikes may occur in the future.
Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high in the process of getting inflation back down to 2%.
The reason for not immediately raising rates is as follows. Powell stated that by maintaining the target range and keeping the federal funds rate steady during this meeting, the committee can assess additional information and evaluate its impact on monetary policy. In simpler terms, Powell wants more time to gauge the future direction of inflation. And based on his analysis of upcoming meetings and inflation projections, the committee will decide how much further they need to raise interest rates. And the approach is rooted in studying data and making informed decisions, basically. When it comes to inflation, two key indicators demand attention. Number one is the Consumer Price Index, CPI, which is core inflation, and CPI represents the headline inflation figure discussed in the news, reflecting the increase in prices of goods and services over time. Now, on the other hand, core inflation differs by excluding volatile components such as energy, food prices, and it's to provide a more stable and reliable measure according to the Federal Reserve Bank. And the bank has emphasized that the significance of monitoring core inflation to gain a better understanding of the overall inflation trend and asset prices changes in the economy. Now, to illustrate the disparity between inflation and core inflation in recent years, let's examine data from the Federal Reserve Bank. Now, in June 2022, CPI reached its peak of approximately 9%, raising concerns. However, since then, CPI has significantly decreased. Now, although core inflation has experienced slight decreases, it still remains relatively high and peaking at around 6.5% and currently settling in the low 5% range. Therefore, while some decline has occurred, it is still far from the desired target of 2%. Now, this 2% might be imaginary, but we'll see how it goes. Now, the Federal Reserve Bank diligently monitors core inflation to inform its decisions about the economy. They analyze the same inflation data as public, but also consider other economic indicators. And their observations have led them to conclude that the economy is slowing down. Like, I could have told them that. Now, however, the situation is not looking promising and circumstances could deteriorate beyond expectations, and the interest rate hikes implemented thus far are starting to impact the economy. The challenge lies in avoiding excessive measures that could break the economy while attempting to tame inflation. Gradually raising interest rates to around the mid 5% range is a strategy, and aiming to reduce inflation without causing a severe recession, basically. This is the Federal Reserve Bank's hope, but risks are involved. And if they fail to take a sufficiently aggressive stance against inflation, several outcomes may unfold. Just as the saying goes, when you try to please everyone, you end up pleasing no one. And the bank walks a tightrope, seeking to strike the right balance. And at present, those in charge are doing their utmost to manage inflation while keeping the economy in check. It's a delicate balancing act, aiming to reduce inflation without inflicting excessive harm to the economy. Nevertheless, attempting to please everyone often results in pleasing no one. And if inflation does not decrease rapidly and the economy continues to slow down, the Federal Reserve Bank may be compelled to adopt even more aggressive measures against inflation. And paradoxically, this would further harm the economy. The pivotal question arises: what will the Fed prioritize? Will they concentrate more on controlling inflation or supporting the economy? This question has lingered since 2020 and has been a topic of discussion in 21 and 22, and now in 23 the consequences are starting to unfold. Now, if the economy begins to suffer, the Fed may opt to stimulate it and turn on those money printers once again, and this can be accomplished by cutting interest rates and increasing the money supply, printing it out. So such actions inject more cash into the system, encouraging spending and providing a boost to the economy. However, there is a cost to this approach, and what it is higher inflation. Now imagine a sudden drop in mortgage rates to 4% tomorrow. The housing market would surge, lending to skyrocketing home prices, and the result? Increased inflation once again. So we're faced with a deteriorating economy. Various scenarios can transpire. And firstly, if the inflation issue remains unaddressed and the Federal Reserve decides to cut interest rates, it may appear as a temporary solution to stabilize the economy. However, this approach can exacerbate the inflation problem in the long run, akin to applying a band-aid to a wound without proper treatment. Consequently, we may encounter additional challenges. Now, if the Fed focuses on inflation while disregarding the economic distress experienced, they may continue raising interest rates, and this course of action proved detrimental to the economy. Higher interest rate increased costs, particularly mortgage rates, discouraging people from purchasing homes, cars, and other goods. And as a result, the economy suffers further, all in an attempt to curb inflation. Recessions and economic downturns are not uncommon. They occur approximately every decade, as witnessed throughout the past century. The positive aspect is that we have learned how to handle recessions. We possess various tools at our disposal, such as cutting interest rates or implementing quantitative easing, which involves more money. These measures have often aided in boosting the economy. However, this time after the 2020 pandemic, we face a different challenge. Escalating inflation, it's like a double whammy. Combating an economic downturn with rampant inflation poses a complex problem. Consequently, determining the Fed's priorities, fighting inflation, or revitalizing the economy is vital. Inflation is not an abstract concept restricted to economists' discussions. It's a real problem that affects everyone, including ordinary individuals like you and me. When inflation is high and persists, it harms us all. Now, if you like this video, check this video right here.